Most of us grow up believing money is simple. You work hard, earn a paycheck, save what you can, and eventually, physical assets provide security. But more than a century ago, an American doctor traveled to the Pacific island of Yap and found a system that works on a different principle. The people there traded using enormous limestone discs, some weighing several tons. When someone bought land or livestock, the stone didn't move. Ownership changed because the village updated their shared understanding of who the disc belonged to. That mental ledger was enough. One story was even stranger. A family stone sank to the bottom of the ocean during a storm. No one could recover it or even see it, yet it continued to be used for trade. How can an invisible rock at the bottom of the sea function as money? It only works if the stone itself has no value. The transaction worked because the stone wasn't the point. The shared agreement was. If a sunken rock can still buy a house, then wealth is an act of collective trust, and understanding that trust requires unlearning almost everything we assume about the world. To understand our modern world, we have to dismantle the myth that money was invented to replace barter. We're taught that people swapped fish for bread until the logistics became too difficult. Anthropologists have spent decades searching for a single civilization that relied primarily on swapping goods. They never found one. The earliest economies were actually built on promises. If a neighbor helped repair your roof, you didn't pay them in grain. You simply remembered the obligation. Humanity's oldest known writing consists of accounting ledgers. These clay tablets track exactly who borrowed tools or livestock and when they promised to repay. Human civilization thrived using these recorded obligations for 2,000 years before the first coin was ever minted. Money has always been a conceptual tool used to measure value. The object was never the point, the ledger was. Think of money as a ruler. A measuring tool only works if its unit, like an inch, never changes size. This is why societies originally tied money to scarce metals. It prevented anyone from easily manipulating the measuring stick. Ancient Chinese merchants eventually moved away from iron coins because they were too heavy to carry on dangerous roads. They left their metal with trusted shops and traded these paper receipts instead. Centuries later, English goldsmiths realized that since people only traded the receipts and rarely claimed the gold, they could print additional receipts for gold that didn't exist. This practice eventually became government policy. In 1971, the United States officially ended the dollar's convertibility into gold, permanently cutting the tie between the currency and the physical vault. By severing that link, modern money reverted to its original state, a shared belief backed by nothing but the confidence that everyone else will continue to believe in it tomorrow. Many people assume that when they take out a loan, the bank is handing them money from someone else's savings account. In reality, new money is typed into existence when a loan is approved. The borrower's promise becomes the asset, instantly expanding the money supply. Because borrowers repay loans with interest, more money must be continually borrowed. This expanding supply drops purchasing power, creating inflation. Who actually benefits from a system where the measuring stick of value is designed to shrink? Borrowers, including governments, win because they repay their debts with dollars that are worth less than the ones they originally received. Meanwhile, the printed number on a saver's cash never changes, even as the goods it can buy steadily vanish. A dollar represents a fluctuating unit of trust, bound to an ever-expanding ledger of debt. Understanding this history reveals that holding static cash is participating in a perpetual cycle of belief that quietly penalizes those who stand still.